Today class, we will have a review for the previous two chapters, which is chapter 9 and chapter 13. And then we will go, if we have time, we will go through the chapter 14, which is the first cycle, accounting cycle. We will discuss everything in details. Okay, so as we mentioned earlier, materiality, it is about something significant. So what is materiality and why we mention materiality? Always when we mention materiality, we bring it with risk and evidence, because when we determine the materiality, it depends on the risk, how risky is the account or the company itself. And then this one will affect the volume or the amount of evidence that the auditor should collect. Okay, so if we remember, the main objective for auditor is to provide a reasonable assurance that the financial statements are free from materially misstated. So how to know the materiality? How to know is this material and this is not material and immaterial? So we need to decide, auditor need to decide the materiality. So materiality will play as a net, as we can see, a net, and more than can play as a standards or threshold, that below this is not material, above this amount or this cut-off point is material. So I will not go through the details of these things, but what we need to understand of materiality is as I said, is the cut-off point that the auditor will decide in the beginning of the auditing process, which is the stage of planning. When the auditor start to plan when the auditor do the planning for the auditing process, they need to determine how much is the materiality, which we call it the preliminary materiality judgment. Why we call it judgment? Because it is not cut. It's not one figure we can apply, because it is judgmental. It is subject to the experience, to the type of client company, and it depends also in the integrity of the management of the client. It depends in the risk assessment process. So it's not, you cannot use the materiality, let's say, for the client company for last year, you apply it in this year. Cannot, because it's not absolute amount. It needs to be changed based on the year, the time, also the client itself, and it depends in the size of the company. Okay, so I give this easy example. Last time I said if we determine the materiality threshold in 5,000, then we will select the three transactions, only 3 transactions to be tested and to be as included in our sample, or what we call to be considered as audit evidence. But if we decide to have to reduce the materiality threshold to be 3,000, then we will have more transaction to be included in our sample. So in that case, we can see that there is an inverse relationship between the materiality level and the sample size. The more the materiality, the less is the sample size, and the more the less the materiality is, the more the sample size or the evidence. Okay, this one you can see in details later on in this chapter. Okay, so I will not go through all of this, but what I want to mention is this very important factors that affecting the judgment of determining the materiality, estimation of materiality. So we need to bear in mind, we need to take note that the materiality is relative rather than absolute a concept. As I said, it's not absolute amount that we can apply here and there or from year to year. We need to decide, or it is kind of a percentage that may apply. We estimate it, and based on qualitative and quantitative factors, as we will discuss in a short while. Then we need to know that there is there should be a basis for evaluating materiality. We should take basis like let's say the amount that we should base our materiality is, let's say, total assets or revenue or net income before tax. Normally, the most common one is net income before tax, but it's not applicable to all companies, because some companies in some countries, like I said, like Brunei, Qatar, maybe I think Oman also, they don't have tax. So in that case, we cannot apply net income before tax. So we will apply total revenue. Or some companies like real estate, they would prefer total assets. So when we say total assets, let's say total assets is 10 million, then we need to, this is the base, we need to decide what is the percentage of the total assets to be reflected into the materiality. Let's say 5%. So if 10 million, then the 5% will be 500,000. So above the 500 is material. Above, if there is any misstatement above the 500, then it's material. Below that, it is not material. And then we should also consider the qualitative factors that may affect the materiality. What is the qualitative factors? Like what stock market pressure, management bonuses, loan, also any change in the board of directors, slight loss to slight profit means moving the company. Normally it's gaining profit, and then suddenly it's moved to slightly loss. So we need to consider such movement, which may carry some manipulation of the figures in the financial statement, which it's not the basis, it's not quantitative factors. So we need to agree now in three things. One, the materiality threshold is not absolute concept, it is relative. And normally we take a percentage based on something from the financial statement, some figures in the financial statement, normally net income before tax. And not only that, we need also to consider the qualitative factors that may reduce or increase the what we decide what we decide as materiality cutoff. Okay, so we need to bear in mind that there is no standards, either accounting standards or auditing standards, provide specific guideline to estimate the materiality, but they just bring some guideline from best practice by the auditor. So by that, we should understand that the professional judgment is playing a significant role to determine the materiality. Okay, so we have 5 steps to applying the materiality. Step 1 is to set the preliminary judgment about the materiality. And in this, in step 1, we just mentioned just now, we need to have a percentage based on specific indicator, which is, as we said, let's say we decide it's net income before tax, as the example we have last week. So we will have, let's say, 5%. So 5% is the preliminary judgment about materiality. But let's say we have some qualitative maybe qualitative issues or factors that maybe increase the risk. The auditor feel is now the company is more risky, so they may modify that amount or that figure come from quantitative by the qualitative factors. So we will reach to setting up the preliminary judgment about materiality, and this one in step 2 we will allocate the preliminary judgment about materiality to segments, and this segment is based on the financial statement figures, and when we reach to this point we will call it tolerable misstatement. So this one I think we did an example last week, and we try to explain how it goes, step 1 and step 2. Take notes that step 1 and step 2 are in the planning, the planning stage of auditing. Okay, so let's move to step 3, 4, and 5, which is in the evaluation result. So step 3, when we after we estimate the tolerable misstatement based on segment or account of the financial statement, so we need to first extract the sample, and then from the sample, when we run the test, we see if there is a misstatement, and then when we get the misstatement, we this is let's say we have when we run the test, the substantive test of transaction, we reach to, let's say in the account receivable, we reach to 300,000 misstatement. So that's the step 3, estimating total misstatement in the segment. Okay, so step 4 is to accumulate or combine the misstatements, and when we combine them, so we need to compare again with the amount we planned or we estimate in step 1. So we compare the result of step 4 with step 1 to find the step 5, which is compare, combine, estimate with judgment about materiality. Are you okay up to this point?
Okay.
Okay, sir.
Okay, thank you. Okay, so okay, so the reason I'm trying to emphasize here, because this is something most of the students are misunderstood those concepts, which is very important. So that's why I keep repeating the things and try to explain again and again. Okay, so step 1, this is kind of explanation. So in step 1, as I said, let's say we have the materiality of financial statement. We decide that 5% of gross profit after depreciation, and then we set up those amounts. So this is quantitative because it's percentage based on the amount, it's the figures of financial statement. So in this, then we have this example. We have they decide to have total assets, to have the basis of the tolerable misstatement is the total assets, and the total assets is 10 million, and then preliminary judgment is the it will based on 5%, it will be 500,000. And remember, we discussed about the qualitative aspect, and based on those kind of examples of qualitative factors that may affect, which is nature of business operations, size of the company, and volume of business transaction, prior client history and integrity, and those may affect the amount. So, however, due to the client history and riskiness of the industry, the company is deemed riskier than the norm. So in that case, auditor will decide to reduce the 400 instead of 500,000 to be 400,000 for the total assets, for the current assets. So we reach now to the point we need to understand that the first the preliminary judgment or the materiality is not absolute amount, it's relative, and it is based on certain figures in the financial statement, and it is based on qualitative and quantitative factors that will shape the amount of materiality, preliminary judgment of materiality. Okay, so this is step 2, so I will not go through, but I believe we know what is unknown misstatement and likely misstatement. Unknown misstatement means something is the auditor easy to determine and specifically know what is the amount of misstatement. Likely misstatement, which is the management estimate something, or the management of the client estimate something, they stand on something, they have the justification for changing the methodology, the method of depreciation, and then you have different opinion. So it's like likely misstatement. It's not clear, cut and clear like crystal. So the auditor should play a role in that because it's quite important. So what I will do now, I will come with example. This example, which I believe is quite, this example. So we in preliminary judgment, this example bring us with the figure amount of materiality, which is 50,000. Step 2 is to break down this preliminary judgment of materiality to into accounts, so into segments. So we have under the current asset, we have cash, account receivable, and inventory. So based on the management, also based on the auditor judgment, and also the history, qualitative, quantitative, auditor come out with this formula, or this recipe of terrible misstatement. So cash will be 4,000 terrible misstatement, 20 will be account receivable, inventory will be 336,000, total will be 50,000. Bear in mind that those normally in the exam they will give you indicators to determine this, and in case they didn't, so they will ask you to allocate the preliminary judgment of materiality based on the riskiness of the account. So cash is less risky and easy to audit. So when you come to allocate the terrible misstatement to the accounts, you need to have to take note that there is 3 factors affecting. One is the riskiness of the account, and number 2 is the easy or the difficulty level of the auditing this account. So if it is difficult to conduct the auditing for that account, so better to make it more. I mean more terrible misstatement, to determine more terrible misstatement. And number 3 is the size of the account. The size of the account. Okay, so now we have the estimate of total misstatement in segment. So we have 3,500 net misstatement of the inventory sample. Then we have we divide it in about for the total inventory sample, which is this one is the total amount of inventory. Okay, so and then the total amount of recorded population under inventory. So we need to multiply because it's 450,000. So we get in the end is the direct projection estimate of misstatement, which is step 3. Remember, we are in step 3, we are doing the work of auditing. So this one is based on auditing. So which means when we audit the sampling, when we audit the sample, which is our sample, the sample was 50,000. So 50,000 of inventory. So we found that 3,500 is net misstatement. So net misstatement in the inventory sample that we collect is 3,500. So we need to project this or reflect it to the total amount of recorded inventory, which is 450,000. So the total direct projection estimate of misstatement is 31,500. Okay?
Okay, sir.
Okay, so now what we will do, we will then we do the same things to the other accounts, cash, account receivable. So for the tolerable misstatement column, which is this one, we have it from step 2, sorry, and step 2 we need to accumulate this amounts. And if you notice, we have 0 direct projection for cash. Reason, because we did it normally for cash, we did not take sample. We audit the total amount of cash. So because it's easy to count. So we go to the company, we ask them to check the exact amount they have in hand, and then we contact the bank. We in specific point of time, we get the bank statement, and then easy we get we audit the cash on hand or the cash of the company. That's why we don't have direct projection and no need to do sampling. So it's 0. Okay. So account receivable. Yeah, we need to have direct projection. So the sample error, usually we estimate it based on 50%. And if there is a question, they will give you this point. So in this case, the total tolerable misstatement, we get is 47,250, which is the amount that we or the step number 4, which is combining the estimated tolerable misstatement. Okay, and then step 5 is to compare. We compare. So total is estimated misstatement amount is the is 60,300, which is 18,000 plus 74,250. We then we compare it with the preliminary judgment about the materiality, which we get in step 1. So by comparing that, we found that estimate combined misstatement 60,300 ringgit is more than the preliminary judgment of materiality 50,000. So what is the decision? What is the consequences? Because of this, the auditor may decide that the financial statements are not acceptable. The auditor may perform additional audit procedures to reconsider the estimate or required judgment for estimated misstatement. What do we mean by the auditor may perform additional audit procedures to reconsider the estimate? And what the auditor will do will increase the sample size just to confirm that this amount we get, the 60,300 is correct. So we extend, if we, let's say, we extend for, let's say, instead of having 50,000 of inventory, we extend to have another 50,000. So we have, then we see if we will get 31,000 or not. If we get another 50,000, so we decide, yeah, it is material, and then we may consider this is materially misstated, and then we ask them and the management to adjust their financial statement accordingly. Okay. So I will, this is what I explain here, and for sure if we come out, if we confirm that the total misstatement is more than the preliminary judgment, and so it would reflect in the auditor opinion, giving them qualified report. So this is about audit risk. This is kind of easy topic, so I believe you can understand it by your own, and it has been explained in details in the video, recorded video, so you can review in the YouTube. Okay. So with this, I will move to the next topic, or chapter 13. Yes, this is the. I will move to chapter 14. And those factors that method practitioners use to assess acceptable audit risk. This one is, it has been, it will be mentioned, it has been mentioned in chapter 8, and also it will be mentioned later on in the next or the following chapters. So this is how the acceptable audit risk, inherent risk, and factors influencing risk are related. So if we see here, the acceptable audit risk is having direct relation with the planned deduction risk, whereby inherent risk and control risk are having inverse relationship to the planned deduction risk. Why they have inverse relationship? The reason, because inherent risk, control risk are in the business side, in the client business side. It's not under the auditor control. So acceptable audit risk is what the auditor will deciding to accept. How much risk the auditor is deciding decide to or plan to accept, and normally it is 5 to maximum 10%. Normally it's 5-10%, or sometimes even it reaches to 1% or 2%. Okay, and this will also related to the planned audit evidence or the sample size. Okay, so this one is kind of scenarios. You can go through and listen to the video by your own. So what we will do now, we will move to the next to chapter 13. Okay. Chapter 13, I believe, is very, very important because it bring everything together. It bring the discussion of internal control. It link also what we discuss in chapter 8, chapter 9, what we discuss about materiality, about audit planning, about the audit evidence. It bring everything together and show the link between every topic of auditing. And then it shows how it will affect the auditing procedures, which is the substantive test, the test of control, the substantive test of transaction, and test of details of balance. Okay, and then end of this chapter, we will have a summary of the phases, and I can actually I can direct you in the page in the textbook where is this figure of a summary of the all phases. Okay, so type of test, we need to bear in mind that we have three main types of test. One is risk assessment, which is the assessment of risk in the early stage where when we try to obtain an understanding about the auditor. This one has been discussed in chapter 8. So and then test of control, which is the phase 2, which we try to understand, test how effective and efficient is the internal control system of the company. And normally the test of control expendation or the amount of test or the volume of test of control is depends in the risk assessment in step 1 or in the type 1. So risk assessment, and when we say risk assessment, we assess the inherent risk related to the business and industry, and as well as the control system, internal control system risk. Okay, so based on that result, we will conduct the test of control. It will shape the test of control, and test of control result will shape the substantive test procedures. As substantive test procedures, we have two types. We have substantive test of transactions related to the transaction itself, and then we have substantive test of details of balance, and normally we will focus on the balances and the time of the financial statement issuing of financial statement time. Okay, so further audit procedures and audit risk model. Remember, we have this model, audit risk model, which is the audit risk over the inherent risk multiplied by control risk and planned deduction risk. So test of controls, if you see here, the first box is test of control, is and substantive test of transaction. These two are closely and directly related to the control risk assessment. And for the substantive test of transaction and analytical procedures plus test of details of balance are related to the planned deduction risk. And this one should equal to sufficient competent and evidence. So in terms of the evidence, sorry. So if you try to understand that test of control will determine the subsequent test amount and quality and type. Okay, so this is the steps. What we normally we have 5 steps of testing methods using for audit observation, inquiring, observation, examination, or inspection of evidence, re-performance, and then computer assist audit techniques. So, and if let's take example of role of all audit tests in the sales and collection cycle. This one we will have it in chapter 14, but just to understand where the auditing tests will allocated. So when we are in the transaction level, see, this is the transaction level. When we have transactions, so we will do test of control and substantive test of transaction, substantive test of transaction, and analytical procedures. Okay, so same thing, we will do the same, but in the end of the, when we get the balances, the end of balances, end of the period, we will have analytical procedures and test of details of balance. Okay, I hope that's clear, because this page, I believe it explains a lot, and if you understand the clear difference between the 3 or 4 tests. By the way, what is the main functions? What is the main test or procedures, audit procedures? What is the main audit procedures? It is 4, mainly 4. 1 is test of control, 2 is analytical procedures, 3 is substantive test. Under the substantive test, we have substantive test of transaction and substantive test of details of balance. Okay, so you need to allocate it based on the timing and the right time to conduct. Okay, level, and here we have balances level. Okay, so test of control. In this diagram, we will try to link the type of evidence which we discussed in chapter 6, the chapter of audit evidence, and we also discuss the type of audit procedures. So test of control, we need to collect documentations, observation, and inquiring of the client and re-performance. How about substantive test of transaction? Substantive test of transaction, we will do documentation also. We will have inquiring of the client and re-performance and recalculation. Okay, so we can see that in substantive test of transaction, we start to have some recalculation to ensure the accuracy, the audit objectives of accuracy. Okay, whereby analytical procedures, we will have analytical procedures and inquiring of the client. Why we have inquiring of the client? Because remember, analytical procedures is based on financial information and non-financial information. Non-financial information, usually we get it from the inquiring that information from the client. Then lastly is test of details of balance. In test of details of balance, you can see that we do physical examination. We have confirmation of the balances, either the account receivable or the cash by sending, requesting the bank statement, or the account receivable by requesting confirmation later from the client, from the customer of the client. Then we will conduct documentation. We will also inquiring of information from the client, re-performance and recalculation as well. Okay, so this diagram will explain the audit assurance at different level of internal control effectiveness. So let's say we, if you see the horizontal, we have no issue. We have the internal control effectiveness. So A, it means less effective. C, it means the internal control is more effective or strong internal control. Whereby the vertical is about the acceptable assurance or non-assurance. So if you see here the C3 or C2 or C1, it determined that the combination between the two. So the cross between the two matrix, which is the audit assurance and the internal control effectiveness. So let's say the internal control effectiveness is in the level in C2. So audit assurance from control risk assessment and test of control. So we decide that we will accept audit assurance will be better if the internal control effectiveness is more and significant. Okay. So now we try to verify variation, the differences or in evidence max. So test of control, normally this one is scenarios. We have a few scenarios. So in scenario 1, we have, let's say we have extensive test of control evidence. We collect more evidence in test of control. So it's expected that we will collect small volume of substantive tests of transaction, and then analytical procedures will be extensive. Why extensive? Because analytical procedures is easy and less and we call it cost effective. It's we get more a lot of information from the analytical procedures with minimal cost. Okay, so substantive test of details of balance will be small. So if you see that test of control achieve what is next of the amount of evidence we collect in the specifically in the substantive test of transaction and details of balance. So we can see that test of control volume of evidence is having inverse relation with the volume of evidence of in the following transaction. Okay, so let's see the second scenario. So if the test of control evidence we collect in scenario 2 is medium, then it's expected substantive test of transaction will be medium, the analytical procedures will be medium, and test of details will be medium as well, but you can see the analytical procedures still remain as extensive. Okay, so let's say scenario 3 saying that the auditor decide not to collect evidence or to run test of controls, maybe due to that this company have a lack of internal control system or not effective system, internal control system. So the auditor is jumping from test of control. So what the auditor will do? Will do extensive substantive test of transaction, medium analytical procedures, and extensive test of details of balance. Why medium analytical procedures? The reason because remember most of the input of analytical procedures, ratios and so on, it comes from the company. Since the company have ineffective internal control, so it is assumed that the figures, all of the figures in the financial statement is not accurate, or it's not we cannot rely on them. So we do medium analytical procedures. Scenario 4, when we have medium test of control, but the auditor feel that yeah, it's medium level of test of control and also the result of it, but we he prefer the finding of the test of control is shows that the internal control is not effective. So the auditor will do extensive substantive test of transaction, extensive of analytical procedures, as well as extensive test of details of balance. Now let's move to the audit program. We have three main parts: test of control and substantive test of transaction. Part 2 is analytical procedures, and part 3 is test of details of balance. So we need to have the idea why we determine the part 1 test of control and substantive test of transaction in one part in the audit program, because we can do test of control and substantive test of transaction in the same time before the year end, the accounting year end, before December. Okay, whereby analytical procedures, we put it in a separate part, because analytical procedures normally we conduct it in the beginning of in the planning stage of auditing, and during the testing, and after the end of testing. Okay, so it has different features. Then part 3, test of details of balance. Usually it happens end of the year, when we have the trial balance, when we have when we close the accounts, when we have the balances in the draft of financial statements. Okay, so what is the methodology for designing controls and substantive tests of transaction? We should perform, if you remember, we should start with risk assessment to understand the internal control. So when we do the assess control risk, we determine the extent of test of control, and based on that we design test of control of substantive test of transaction to meet the transaction related audit objectives. And normally we need to have those three factors. To have those four items in our audit program related to the control test and substantive test of transaction. We need to determine what audit procedures to apply, and what is the sample size, and what item to select, and also the timing to perform those audit procedures. Okay, and normally the timing for internal control test and substantive test of details is before year end. In some textbook or in some audit companies, they refer to starting from August, or even sometime earlier than that. Okay, so test of control and substantive test of transactions. We start by applying the transaction related audit objectives to the class of the transaction being tested. So we need to determine what is the audit objectives related to the class of transaction. Next, we need to identify the key controls that should reduce the control risk for each audit objectives. And then number 3, develop appropriate test of controls. Number 4, design substantive test of transaction. Please keep this in mind, because those steps we will repeat it again and again in auditing the accounting cycles later on, when we talk about revenue cycle, when we talk about purchase cycle, when we talk about payroll cycle. All of these steps will be repeatedly mentioned, but it's good for you to understand the concept now, so later on it's kind of reflection and using it as in the applying those understanding concept later on. Okay, so 4 steps approach. There is an approach called 4-step approach to design, control, and substantive test of transaction. Step 1 is to apply transaction-related audit objectives to select to class of transaction. The one I mentioned just now is same, but we put it in a different form. Then step number 2 is identify key controls and make a preliminary assessment of control risk. Number 3 is to design the test of controls, which I mentioned the 4 items should be within the design: audit procedures, type, sample size, item to select, and then the timing. Lastly, we need to design step 4 to design the substantive test of transaction. And we need also to have the 4 items to be included in the design of substantive test of transaction in terms of what audit procedures, what sample size, what item to select, and what is the right time to run the test. Okay, so now we move to methodology for designing tests of details of balance for account receivable as an example. So now we are trying to have the third part, which is the methodology for designing tests of balance of details. So number 1 is identify the client business risk affecting account receivable, and step 2 is set up tolerable misstatement and assess inherent risk of the account receivable, and assess control risk for sales and collection cycle. If you notice here, we start to the step 1, we identify the client business risk. Okay, we identify the inherent risk here of the business itself, So how risky is the business itself related to the account receivable. Whereby in the step 2, we set up the tolerable misstatement. Remember, in chapter 9, we talk about tolerable misstatement. We set up the tolerable misstatement here and assess the inherent risk related to the account receivable itself. So in this case, in this step, we are not assessing overall business risk. We are assessing the account itself in terms of recording, in terms of documentations, and so on. Segregation of duties and so on. Okay. Step 3, we assess control risk for sales and collection cycle. So we assess the internal control risk system, and then we start here to design and perform tests of control and substantive tests of transaction for sales and collection cycle. This one and this step, when we design this is in the previous slide we mentioned it. So we summarize it in one, and then we come out to we reach to design and perform analytical procedures for account receivable. And finally, we design test of details of account receivable balance to satisfy the balance related audit objectives. And we have the same items that should be involved in the design of test, which is the type of audit procedures, the sample size, the item to select, and the timing. To do so, then we will have this. This is just to simplify. So just now we mentioned that we are applying transaction related audit objectives to class of transaction. Sorry, this slide is explaining the approach to design test of details of balances. So remember, from the part 1, we have the 4 steps to design the transaction related 4 steps approach to design test of control and design of substantive test of transaction. So this is a kind of summary for it. So here the output for both designs will shape the approach to design test of details of balance. So, but with those 2 outcomes, we also need to consider making preliminary judgment about materiality, and we decide the tolerable misstatement, and we we design analytical procedures, and then we also decide the acceptable audit risk. All of this input will will be applied in balancing. We need to determine or specify what is the related audit objectives to the account receivable for the balance related audit objective. And also we need to assess the client business risk and inherent risk. All of this will bring us the result of designing test of details of balance. And designing test of details of balance, we need to have the 4 items, which is the audit procedures, type of audit procedures, sample size, and the item to select, and then the timing. Okay? So now we will discuss the relationship of transactions related audit objective to the balance related audit objective. So we have transaction related audit objective. We have existence, competence, accuracy, posting and summarizing, classification, and timing. And in balance related audit objectives, we have existing and completeness, existence, accuracy, details, tie-in, classification, cutoff, realizable value, rights, and obligation. So this relationship, we have direct for the first 3, and we have no relation with regard details, tie-in, and posting and summarizing. Whereby classification in the level of transaction, we have direct relationship, whereby realizable value, right, and obligation don't have, there is no relation. So this one will help us later on when we discuss the audit objectives and the substantive test of transaction and details of balance, help us to understand what objectives should we test, and we will have clear examples later on. Okay, so now let us have the discussion. Let us discuss the relationship among 5 key evidence related terms. First one is phases of audit procedures, audit process. Number 2 is audit objectives. Number 3 is test of test, type of test. And number 4 is evidence decision, and number 5 is type of evidence. Number 4 is evidence decision. Okay, so sorry. Okay, so remember this, we have 4 phases of auditing. We have phase 1 is the planning and designing audit approach. Phase 2 is performing test of control and substantive test of transaction, which will link to performing analytical procedures and test of details of balance. And phase 4, which is completing the audit and issue audit report. And this one we can have it in different summary of audit process in phase 1. In phase 1, we will have accept the client and perform initial planning, and then understanding the client business and industry, assess the client business risk, and perform preliminary analytical procedures. So all of this is in the planning stage or planning phase, which is phase number 1. Okay, so also in phase number 1, we also will set up materiality level or cutoff, and we assess the acceptable audit risk and inherent risk. We will understand the internal control and assess control risk, and then gather information to assess fraud risk. Those all will help to develop overall audit plan and audit program. Okay, and audit plan, what we get here will come to phase 2 as an input. So plan to reduce, we will have the plan to reduce the assess level of control risk. So if we have that plan, if no, then we will we start with yes. If yes, we will perform test of control and perform substantive test of transaction. But if we have no plan to reduce the assessed level of control risk, we are satisfied with the phase 1 finding about the internal control and understanding. So we have the feeling that performing test of control will not give different result. So we in that case we will go direct from we will not do the perform test of control, we will go performing substantive test of transaction, and we will come out to the conclusion. The output of this phase 2 is assessing the likelihood of misstatement in the financial statement. So we now in this stage we will know whether the likelihood of misstatement in the financial statement is high or low or medium. So if it is low, then substantive test of details of balance and analytical procedures will be affected based on the result of phase 2. Okay. So this is in the case we decide to not to rely on not to conduct more internal control test. Okay, so the result of the phase 2 will come as low or medium or high or unknown, means likelihood of misstatement in the financial statement. So that will shape and help to plan the perform analytical procedures, perform test of key items, perform additional test of details of balances. Okay, and then in phase 4, which is the last stage or the last phase, which we will auditor normally will perform additional tests for presentation and disclosure, accumulate final evidence, evaluate the result, issue audit report, and communicate with the audit committee and the management. And normally this phase we will have it in details later on. I think we will discuss it in chapter 3 end of the semester. Okay, so now we are moving. After we understand the audit planning and we understand what we will do during the test, and we understand the link between the stage 1 or the phase 1, which is understanding the client, obtaining understanding, assessing internal control and inherent risk, and all of this information will help in putting overall plan of auditing procedures. And then if we are satisfied with the result of the test of control, then we will not conduct test of control again in phase 2. But if we are need to collect more information, we need to ensure we are not sure about what we get in phase 1, then we will go for test of control. Normally, if we have existing client, so we already audit the client company for a few years, so no need to I believe no need to do test of control much. We will reduce the amount of test of control, and we will focus in substantive test of transaction and details of balances. Okay, and then we will phase 2, the output of phase 2 is about the likelihood of having misstatement in the financial statement, and low, high, medium. So all of this will shape the amount of evidence to collect and test to run in during the step 3. In step 4 is the final one, which is completing the auditing procedures, doing additional test analytical procedures to conform, and then we have the last one. We issue the audit opinion and communicate it with the audit committee and the management. So now I believe we complete the audit planning and so on. I hope you go and review what we have today and the previous chapters, because next week it will be kind of practical things. So now, before we go on, let's discuss the transaction cycle, because this one, or the accounting cycles, or the transaction process cycle, this will help us to understand the how to audit, how the auditor think about this kind of segments. So the transaction cycles model is one way to view the basic business process. The purpose of transaction cycles game is to provide drill and practice or review of the element that comprise the 5 typical transaction cycle identified as revenue cycle, expenditure, or sometimes we call it purchase cycle, production cycle, human resource payroll cycle, and financing cycle. Okay, so let's see this example. Normal client company, they will have assets and property and cash. So they will buy from suppliers, they will purchase from suppliers, isn't it? And then they will have inventory, and then they will sell, and they will have revenue from customer. Okay, so customers will give and also the cash will come from either borrowing, from financing, borrowing, or asking the owners to pay. Okay, so this will bring cash to the company, and then HR, we need to pay salaries. Okay, payroll. So by understanding this accounting cycles, we can break down these cycles into different cycles to help the auditor to audit the accounting cycles based on those concept, the concept of accounting or transaction cycles. Okay, the items on financial statement are categorized based on these cycles and audited also based on this. Okay, so this one, I believe we mentioned it earlier, how the cycles are related to each other. Okay, so with this, we finished the discussion of the chapter 13 about the audit planning or overall audit planning. So I open for question and answer for some time. So if you have question, please raise your hand or just start talk.